This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Mike Savino. The financial troubles at FGMC and Sprout are prompting questions about whether non-QM lenders can find the investors they need to continue. Well, that pressure is only growing, with Flagstar Bank placing new restrictions on funding advances for these non-QM lenders. In a text message sent to staff and obtained by the Mortgage News Network, the company says that effective immediately, funding advances for non-QM loans targeted to the investors listed below will require additional advances, and haircuts may be adjusted. Flagstar identified 16 lenders that require this additional approval, including Angel Oak Mortgage, Deep Haven Mortgage, Redwood Trust, and Standard Mortgage, among others. A Flagstar spokesperson confirmed the text but would not say whether the change is in direct response to the financial troubles at FGMC and Sprout. We have always reviewed certain non-QM loans before funding them, and we're simply adjusting this process. Now, just a week ago, Sprout executives abruptly closed up shop and told more than 300 employees that they were out of jobs. According to sources, the announcement came just hours after CEO Michael Strauss nixed a deal with Citibank. And in June, FGMC used a virtual meeting to lay off some 470 employees. Flagstar's change comes amid broader questions about the future of the non-QM industries. Investors worried about a recession want higher mortgage rates, but as one expert points out, if we go into a recession, investors of these loans are also worried that businesses of these non-QM borrowers will be affected negatively. At the same time, experts also say that if non-QM lenders also want to attract warehouse funding, they will need to up their mortgage rates even more, especially if the Fed raises the federal funds rate again. And that's almost certainly going to happen because inflation rose again in June. For the year, the CPI is now at 9.1%, continuing a 40-year high in price growth. So what's driving this inflation? Well, if you look at food prices, they're up 10% over the last 12 months. And here you have the biggest driver, energy prices, up 41% year to year. But even if you take those things out, core inflation is still up 5.9% over the last 12 months. What's driving core inflation? Well, some other things that people still need to pay for, including transportation costs, still up over 8%. Medical care, up almost 5%. And here you have shelter costs, up 5.6%. That's the fastest increase since 1991. And experts are worried it's just going to get worse because those costs can take 6 to 12 months to show up in the inflation data. So that means rapid growth in rent expense over the last year is only now beginning to hit the headline CPI figure, which means there's more upward pressure to come. These numbers raise questions about what the Fed will do when it meets again at the end of the month. The Fed board got more aggressive at its June meeting with a 75 basis point hike, but that hasn't done anything to slow inflation. This acceleration means that there's a lot more work for the Federal Reserve to do. One expert says a 75-point increase in the federal funds rate is almost assured. In other news, mortgage applications continue to slide, falling by another 2% from the prior week. Mortgage rates did slide back down, but purchases still fell for the second straight week, this time down 4% from the prior week. The refi index actually showed a slight rebound, rising 2%, but that's not enough to keep up with last year's pace. Refi activity is now down 80% from last year. The drop in loan activity can feel sudden, especially for originators who've just entered the industry in the last few years. And it can be frustrating when business keeps drying up, even though mortgage rates are coming back down. So how do you reverse this trend and turn things back around? Our own Christine Stewart asked an expert.
To stand out against the big guys, right, you need to have a strong online presence, which is where we come in to help you guys win.
Spencer Taylor of Podium says communicating with your customers is important, but what's the best way?
Yeah, texts have a 98% open rate. Compare that to emails where it's 18%. It's a lot higher conversion, and of those 98%, it's a 95% within the first 10 minutes.
As far as social media is concerned, the biggest thing is to focus on what brings the most customers, and that's probably Google search.
That's where people are searching. That's where most of your customers' traffic will be headed to.
Taylor, who recently spoke at the Ultimate Mortgage Expo, says with millennials being one of the biggest home buying markets, loan originators need to pay attention to communication.
Have your Facebook, right? Have your Instagram presence, but really focus on Google because that's going to bring you the most customers and the most money.
For the Mortgage News Network, I'm Christine Stewart.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.